What is going on, you beautiful humans? Today, we're going to be talking about buying a home in a strange housing market. And I did buy and sold in that market that was very silly in the mid 2000s leading up to the Great Recession. And that was just a whole different experience. But in this current situation, inventory is up, prices are still high, and rates are just, let's just say that they're complicated. So before you dive into home ownership, let's walk through what not to do and what smart moves that you can still make even in a weird market like this. And of course, the context here is that right now, the median US home price is just under $417,000. Averages are hovering around $503,000. But something that is happening here is that sellers now outnumber buyers by more than 500,000. And that's actually a sign of cooling demand. And homes are taking longer to sell, now averaging 47 days, triple the time from that 2021 frenzy. And mortgage rates are penned at around 6.85%, just hovering just south of 7%. And I know that there are home builders out there like New Homes where there are some incentives. Just be careful with those, but with no guarantee that they'll drop even if the Fed cuts. And why? It's because it's not just about Fed policy anymore. The 10-year Treasury yield, which is more directly influencing mortgage rates, well, that is climbing due to weak global demand for US debt. So basically what we're saying here is home ownership is expensive, and the forces that made it that way aren't going away anytime soon. Now, before we get into the do's and don'ts, I just want to preface here that I know that you want to have authority over the decisions that you make. I'm coming from a place of experience, and as I've said, I lived that ridiculous experience that if you ever saw that movie, The Big Short, it nailed it on the details. Seriously, it was that weird. So let's just say that I am also very well versed in human behavior, clinically speaking, and we'll just leave it there for now. And now that we've got that out of the way, let's start with the don'ts. So don't let emotion do the negotiation. It is easy to fall in love with a house, but don't let your heart write a check that your wallet can't cash. If the seller won't budge and it's overpriced, just walk. There are more listings now than at any point in the last 5 years. And here's the thing, they have a seller's agent telling them what the comps are. And this is a big human behavior scenario. They are emotionally tied to this property. Don't take it personally. It may take them some time to understand what is happening, and we're not going to judge on that. We are just going to move on. Because here's the thing, if you make an offer, they make a counter, it is not meeting your financial need or where you need to be. And let's say a few weeks later, you're still not finding what you're looking for, and you really do feel good about this home, and they want to come back to the table and maybe even meet you where your number is, certainly have your agent take another look. Don't dig in and say, no. You made us upset the first time and we're just not going to do it. This is not a good situation. Really look at it from an objective standpoint. And the second don't is don't overextend just to get in. So your mortgage should not dominate your income. So aiming for housing costs to stay at around 25 to 30% of your monthly take-home pay. And I know that's just kind of a general calculation. It could be more for you if you feel comfortable, if you have less revolving debt, if you have a situation where maybe you're not going to have daycare expenses down the road, or maybe paying for college or whatever that is. Remember, 80% of Americans can't afford a single family home at today's prices and rates. You are not behind if you're waiting. And as I've said before, don't time the market when the media or even me tells you. You time it when you are ready. And the third don't squeeze equity too soon, or at all, at least in those first few years. Avoid the temptation to open a HELOC right after buying just to upgrade the kitchen. If you want to refinance later, because eventually those rates will come down, they probably won't be that 3 to 4%, but if they are, hey, you're going to want to refinance, and draining equity could hurt your loan to value ratio and limit your options. Put some of that sweat equity in there where you can. And the fourth, don't ignore what drives rates. It is a myth that the Fed directly controls mortgage rates. You've got to watch that 10-year Treasury yield, and right now it's moving up. Even if the Fed were hinting at cutting rates, if global demand for US debt keeps falling, rates may stay high or even climb higher. And 5, don't skip the inspection or appraisal. In hot markets, people were waiving inspections to win the home, and that is not a win. That is buying a mystery box with your life savings. Always know what you're walking into. This was actually a tactic when we were buying a home in 2005, and there were so many bad situations people got themselves into, and this was one tactic that we didn't even participate in. And now that we got some of the don'ts out of the way, let's get to some of the do's. So first, do know what you can actually afford. So use conservative estimates, budget for unexpected repairs, property taxes, and rising insurance premiums. And I can tell you, property taxes and insurance premiums will continue to go up. make sure that your emergency fund isn't wiped out by that down payment. And let me actually share a personal experience from 2005. So we had just moved cross country where I got a job offer, and I hadn't even started that job yet. My wife left her job and was able to convert her position into a consulting opportunity. But here's the thing, with a 30-day out on either side of that contract, which could have gone really wrong if she didn't have that professional relationship with that company. But we had already moved all of our stuff and our oldest kid at the time, who was our first kid, out east, and I was standing out on the sidewalk of her mother's home and on the phone with the mortgage broker. I didn't have a pay stub. My wife had just left her job, and they ran our social security numbers. I didn't give them any documents. And of course, we did have good credit, and we just stated our incomes, which was the income that we were going to be getting according to what my offer was and what her contract was. Now, the house that we were interested in was around $300,000. We didn't want anything more than this. And a short time later, the broker says, okay, you're approved. But here's the thing, we wanted to extend an offer to bump up that money that you can borrow to $750,000. Now, I know that would be obscene today, but just be careful out there, my friends, because you can start to easily find yourself in an uncomfortable position. And I'm not saying that that's going to happen to you, but you can understand, like, when people are presented with that opportunity, they might take advantage of it, even though it really does stretch them. And second, do think about the longer term. So think about whether you're going to be staying put for at least around 5 years. Housing markets are local, but if we're heading into a broader correction, flipping a home might not end how you had hoped. And in our situation, we were only back east for about 2 years, but we got really lucky because, again, lucky, or just the fact that it was just a really weird market, we were able to actually sell for a profit. But third, do make DIY your best buddy. Now, this is the time for that sweat equity that I had mentioned. And if you want that fancy backsplash, the lighting, get on YouTube and some elbow grease, and that can stretch your dollar while building value slowly, and of course, without debt. And if you're doing anything that requires pulling a permit, pull that permit. This will bite you back so hard you'll need a tetanus shot afterward when you try to sell the place, if you have the property appraised for any reason, or if you have a homeowner's insurance claim. And four, do consider alternatives, and I've already talked about this in 2 previous videos. The first one is that renting isn't a failure, and it's not a waste. It can be a strategic move while prices stabilize, and I know some rents are very high in some of those areas, and it may not feel like the right move, but look at the longer term numbers, not the emotion. And of course, the other one is to remember that while you're renting, your Roth IRA isn't tied to your zip code. You can build wealth outside of real estate too. And 5, understand the macro picture here. This isn't just about housing, it's about a bigger system built on debt. The US currently right now holds over $36 trillion in national debt, and households have racked up a record $18 trillion. So that puts pressure on borrowing costs and purchasing power. So the thing is that if the market feels uncertain, that is because it is. But uncertainty doesn't mean that you can't take action. Just be patient, be informed, and stay in control of your money. Sometimes the smartest move is just waiting and not rushing, especially when a correction might be just around the corner. I appreciate you being here, and I would love to hear from you in the comments below. And as always, I will catch you right back here on your next level up.